There's so many stocks and ETFs out there to invest in, but I know there's a lot of you that like to invest but want to keep it really simple with just a few ETFs in your portfolio. So I wanted to go over the best 3-fund portfolio, or the only 3 ETFs you need for long-term growth. And honestly, a lot of investors who only use this 3-fund portfolio strategy and continue to dollar cost average into these funds every week end up with even higher returns than those who just pick individual stocks. So it's something that I know works really, really well. Now keep in mind, I am a little bit younger of an investor. I just turned 26, so I have a few more years or even decades longer than someone who's an older investor. So with that being said, this 3-fund portfolio is more growth centered and a little bit more aggressive than, say, a dividend income portfolio. So this specific portfolio is probably better for someone who's more focused on long-term capital appreciation. So jumping into it, the 3 funds in this portfolio are SCHG, XLK, and SCHD. Starting with SCHG, this is a Schwab ETF that tracks large cap growth stocks in the Dow 100, and since its inception in 2009, so about 14 years ago, it's very well been living up to its name. It's returned just under 500% since 2009, including dividends, and even though the year 2022 was pretty rocky for this ETF, its 2-year return is still positive, and it should be back to its all-time highs here in the near future. Another thing that's great about this ETF is it's very cost efficient with a super low expense ratio of 0.04%, meaning you're only paying $4 for every $10,000 invested as a management fee. And I think that's the lowest expense ratio out of any ETF you can find, but I could be wrong, so don't quote me on that. Looking at some of its holdings, it's very heavily weighted in the tech sector. It makes up about 44% of the fund's holdings, and this explains the high growth that it offers with slightly more volatility and risk. And looking at some of the biggest holdings, we can see a few of those big names that we all know of, like Apple, Microsoft, Google, Nvidia, and then there's a few non-tech stocks like United Health Group, ExxonMobil, and Visa. So I'd have about 50% of SCHG in this 3-fund portfolio, and another 25% would go into XLK. So XLK is the technology sector ETF by SPDR, and it also has performed increasingly well over the 10-year time frame, returning just under 500%, including reinvested dividends. And this year it's up about 22% as tech stocks are slowly recovering from that fairly aggressive bear market we had in 2022. The expense ratio isn't too bad either. It's at 0.1%. So you're only paying $10 a year for every $10,000 invested. So still very low when it comes to expenses. So looking at the holdings for XLK, you'll notice some of the same companies that SCHG owns, the one we just looked at. So there is a little bit of an overlap there, but with XLK, it only tracks tech stocks. So there's other growth tech stocks in here like Adobe, Broadcom, and Salesforce that we won't see in the other ETFs. So a lot more exposure to the tech sector with XLK that in turn allows for more significant growth. The other 25% will be in SCHD, which I know most of you have heard of before and probably know a lot about by now since it's been one of the most popular dividend ETFs. And I also talk about it quite a bit on my channel too. But the reason why it's so popular is because it's a very rock solid dividend ETF. And you can always mix and match this one with other dividend ETFs like VYM or VIG. But I think SCHD is perfect as a dividend growth ETF for this specific 3-fund portfolio. So SCHD is paying a nice 3.61% dividend yield with a compound annual growth rate of roughly 12% each year. And looking at its performance since about early 2012, when it was first introduced on the market, it's returned just under 300%, including dividends. But comparing that to the S&P 500, the returns are almost identical, so just owning this fund alone, you're essentially matching the returns of the overall market. And there might be a few years where you'll beat the market by a few percentage points. But the reason why I think this ETF is perfect for this 3-fund portfolio is the fact that you can reinvest those dividends each quarter into really any of these 3 ETFs and continue to fuel that compound interest and make you very wealthy in the long term. So with these 3 funds together, this portfolio has returned an average of 15.76% every year since 2013. And let's assume that average return continues going forward for the next 30 years, and we'll plug it into our compound interest calculator. So if you started out with just $5,000 right now and added $500 a month to this portfolio for those 30 years, at the very end, you'd amass roughly $3.4 million. And again, that's looking forward into the future and assuming that 15.7% return stays as the average. So now let's look into the past and sort of backtest this portfolio to see how it's performed against the S&P 500 in the last 10 years. So starting in 2013 and ending in the present day, so a 10-year time frame, we're going to start with a $10,000 investment and put it all into this 3-fund portfolio. And like I mentioned before, we're putting 50% in SCHG, 25% in XLK, and 25% in SCHD. And we're battling against the S&P 500, or the SPY ETF. So plugging it in, at the end of those 10 years, our $10,000 investment is now at $45,000, and our compound annual growth rate is at 15.76, like I mentioned earlier, and outperforming the S&P 500. And our best year was about 37%, with our worst year, which I'm assuming was last year, 2022, was nearly a negative 24%. But if you look over here towards the present day, you can see that this portfolio recovers a lot more rapidly than the S&P 500. There's more of a bigger jump there. So there is a little bit more volatility, but it does tend to recover from bear markets a lot quicker, which of course is great, especially if you're a little bit younger of an investor like myself. And that's why I think this 3-fund portfolio is not only perfect for growth, but dividend reinvesting as well. I hope all this was helpful, guys. As always, feel free to leave a comment down below and a like on this video, and I'll see you next time.